What if the most dangerous financial decision a young person could ever make was actually putting money into their very first stock? It sounds completely backward, doesn't it? Every financial book, every online guru, and every well-meaning parent tells you to start investing as early as humanly possible. They paint this picture of effortless wealth: just drop a few dollars into a trading app every month, and magically, by 30, you will be sipping coffee on a tropical beach. But here is the silent, brutal reality that nobody warns young adults about. Over 90% of students who dive headfirst into the markets during their early 20s end up losing capital. Or worse, wasting their most valuable, irreplaceable financial asset. If you are a student right now, or someone standing on the edge of making your very first real investment, stop, take a deep breath. Because what you are about to discover in the next few minutes will completely invert everything you thought you knew about building real, lasting wealth, and reveal a hidden mechanism that Wall Street secretly hopes you never figure out. Let us start with a story that takes place in a tiny university dorm room back in 2018. Two close friends, let us call them Alex and Daniel, received an identical cash gift of $2,000 upon starting their sophomore year. Alex was ambitious, eager to jump into the game. He had been watching market trends, reading forums, and hearing stories of ordinary people turning tiny sums into massive fortunes overnight. He immediately took his $2,000 and opened a retail brokerage account. He bought fractional shares of hyped tech stocks, high-yield digital assets, and speculative microcaps, believing that time was on his side. And that early exposure was the ultimate key. Daniel took a completely different, counterintuitive path, while Alex spent his evenings obsessively refreshing stock charts. Watching his portfolio swing wildly up 15% one week and down 20% the next, Daniel did something that seemed utterly boring. He did not buy a single stock. Instead, Daniel spent his money on high-tier industry certifications, specialized software tools, and targeted masterclasses in data architecture, a high-value skill he was deeply curious about. Alex actually laughed at him, calling it a waste of capital when the market was booming. Fast forward 3 years. Alex's investment account, after surviving roller coaster swings, unexpected market corrections, and trading fees, had grown from $2,000 to roughly $2,700. A respectable 35% total return over 3 years, right? But here is what happened to Daniel. The specialized skills he acquired allowed him to land an entry-level consulting contract while still in his senior year, paying him $45 an hour. By graduation day, Daniel was generating more raw cash flow in a single month than Alex had made from his entire stock portfolio over 3 long years. This brings us to the first massive paradox that almost every beginner misses. In your early years, your capacity to generate income will always outperform your ability to compound small amounts of cash when you have a small capital base. A 10% return on $1,000 is only $100. It feels insignificant because it is, but a 10% increase in your human potential can alter your lifetime earning trajectory by hundreds of thousands of dollars. Wall Street wants you focused entirely on the yield of your money, so you ignore the yield of yourself. To truly understand how this dynamic works on an institutional level, we have to look at how world-class companies actually scale. Consider the business breakdown of Amazon during its first decade. In the late 90s, Amazon was generating millions in revenue, yet for years they reported zero profits to their shareholders. Wall Street analysts were furious, calling Jeff Bezos reckless. They kept asking, "Why aren't you paying out returns? Why aren't you storing this cash in high-yield assets?" Bezos understood a hidden strategy that ordinary investors fail to grasp: the concept of extreme reinvestment. Instead of taking the company's early cash and trying to earn a quiet 6% return in external financial markets, Amazon poured every single dollar back into its own infrastructure, building fulfillment centers, optimizing logistics, and acquiring proprietary technology. They realized that internal deployment of capital yielded a 100-fold return, compared to the modest returns of passive investments. It was not until Amazon built an untouchable competitive advantage, what Warren Buffett calls an economic moat, that they allowed those assets to harvest massive passive profits. Now, apply that exact same enterprise strategy to your own life as a student. When you are young, you are essentially Amazon in 1997. Your personal balance sheet is in its hypergrowth phase. When you take your limited income and lock it away into public markets too early, you are essentially stripping your personal business of the very capital it needs to build its own economic moat. Think about it. What creates more financial resilience over a lifetime? Having $3,000 tied up in an index fund that fluctuates with global panic, or having $5,000 invested into a high-leverage skill that allows you to demand a higher income. Regardless of whether the stock market goes up, down, or sideways, this brings us to another psychological trap that traps millions of young minds: the illusion of speed. We live in an era of hypervelocity. We see instant downloads, instant delivery, and social media feeds showcasing 22-year-olds driving exotic cars. Naturally, our brains begin to process wealth as something that should happen fast. But here is the dark structural reality of modern financial platforms. Trading apps are deliberately engineered with psychological loops designed to exploit this urgency. When you open a modern retail investment app, notice how the interface looks: bright green colors, instant notifications, haptic feedback when a trade goes through, and constant updates on market fluctuations. These features are not designed to help you think like a long-term compounder. They are crafted by behavioral psychologists to trigger continuous dopamine releases. The platform profits off transaction volume, not off your long-term success. They want you trading frequently, reacting emotionally to every news cycle, and constantly shifting your capital. Let us look at a real-world case study from financial history. A famous behavioral study analyzed over 66,000 household trading accounts over a 5-year period. The results were shocking. The investors who traded the most frequently earned the lowest net returns of all. Meanwhile, the accounts that yielded the highest overall returns belonged to individuals who had literally forgotten their passwords, or, in some cases, were deceased. Silence and inactivity blew away the most active, stressed-out traders. Why? Because active trading introduces friction, taxes, spread costs, and above all, human emotional error. When a market drops 10%, the human brain registers that loss in the exact same region where it processes physical pain. Panic sets in. Instinct tells you to make the pain stop, so you sell at the absolute bottom. Then, when the market recovers and hits new highs, fear of missing out kicks in and you buy back at the peak. It is a psychological cycle designed to systematically transfer wealth from the impatient to the patient. So, how do you bypass this rigged emotional cycle entirely? The answer lies in establishing what elite hedge funds call asymmetric friction. Imagine two doors. Behind door A is a financial setup where you can easily access your money with a single swipe on your phone, check charts 20 times a day, and buy or sell assets in seconds. Behind door B is a setup where your core savings are completely automated, rooted straight into long-term wealth anchors, and intentionally made annoying to access. Which setup do you think survives a sudden market shock? Door B win every single time, not because the person using it is smarter, but because their system protects them from their own worst emotional impulses. To build true financial immunity before you touch a single market trade, you must follow a 3-pillar framework designed specifically for students and young professionals. Pillar number 1, the cash flow engine. Before you invest in external companies, you must maximize the efficiency of your primary asset, your ability to convert time and skill into high-margin capital. Every dollar you spend on learning, network positioning, and specialized execution in your early 20s carries a compounding multiplier that no stock market index can ever match. Pillar number 2, the liquidity shield. Never, under any circumstances, invest money in volatile markets that you might need within the next 24 to 36 months. Why? Because if life throws an emergency at you, a sudden car repair, a gap between jobs, or an unexpected move, and all your money is locked in stocks during a market dip, you will be forced to sell your assets at a massive loss just to survive. A liquidity shield is not passive cash sitting idle. It is your insurance policy against forced liquidations. And pillar number 3, automated asymmetry. Once your cash flow engine is running and your liquidity shield is fully stacked, you set up a simple, hands-off automation system. You do not watch the charts, you do not read daily market headlines. You set up an automatic transfer that takes a fixed, comfortable percentage of your income every single month and places it into broad, highly diversified wealth vehicles. Then, you walk away and get back to growing your primary business yourself. When you execute this sequence, something extraordinary happens. You stop viewing money as a gambling chip, and you start viewing it for what it truly is. Units of personal freedom. You stop obsessing over daily price swings because your personal trajectory is no longer tied to market volatility, while everyone else is stressed, chasing trends and panicking over minor corrections.